Welcome to Investing in Startups. Our guest this week is David Cohen, CEO and co-founder of Techstars. Techstars is one of the OGs of startup accelerators, investing almost 5,000 startups since Techstars was founded in 2006. David himself is a serial entrepreneur who was the founding CEO of Techstars, later stepped back from that role, and then returned to CEO in 2024. We talked about the problems that Techstars solves for founders, how vibe coding affects accelerators, why Techstars finally opened up in San Francisco, and why bigger isn't better, better is better. Please enjoy.
Joe Mager is the founder and managing partner of Seaplane Ventures. The content here is for informational purposes only and should not be construed as investment, legal, or tax advice. The opinions expressed by guests are their own and do not reflect the views of Seaplane Ventures. Our host, guests, and clients may hold investments discussed in this podcast. Please invest responsibly.
David, thanks for coming on the show.
Hey, Joe. Good to see you. Glad to be here.
Yeah. Well, I've been a Techstars mentor. I've invested in multiple Techstars companies, so I'm a fan of what you guys do, and it's great to have you on and just have a fun, nerdy conversation.
Yeah. Well, thanks for all you've done around Techstars. It's mentoring that makes it work. And of course, love it when people invest too. So it's awesome.
And Techstars has a huge brand, touches a lot of people, but maybe just to start, you just talk folks through just simply like what the big goal is with Techstars and what gets you out of bed with working with the company every day.
Yeah, it's pretty straightforward. The four of us, so Brad Feld, Jared Polis, David Brown, myself, when we started it about 18 years ago now, our own experiences, all of us with entrepreneurship and our different, companies and investing activity was that it was pretty lonely as a game to try to be an entrepreneur. And if you could surround yourself with mentors and a community that cared and wanted to see you win and people that have been there and can help you deal with the challenges that you inevitably face as an entrepreneur, that would be helpful. And so, it sort of started with two kind of goals that are really in sync. One is we wanted to find a better way to do early stage, angel investing. Our view was angel investing was kind of broken. So we wanted to find a better way, and we wanted to improve our startup community. I'm sitting here in Boulder, Colorado, where I live, and it's a place that we cared about, and we wanted it to be a better startup community with a 20-year forward view. And that certainly has happened, but we're always looking ahead and wanting it to be better. So with those two goals, we created Techstars, and kind of the word accelerator got coined, and the rest is history. But I had found as an angel that angel investing was a great way to turn a medium-sized fortune into a smaller one. That wasn't necessarily satisfying. So we wanted to do it better while improving our startup community. So those were the two original goals.
You guys were one of the OGs among accelerators. Today, there's more than 150 in the US. And I think the main well-known accelerators, a lot of listeners on the show could probably tick off the names of those off the top of their head, but that probably leaves another 145-ish that aren't as well known. And I'm curious, as you've seen the accelerator model and what you guys were early pioneers with get replicated, copied in different capacities over time, do you feel like there need to be 150 accelerators kicking around the US? Curious how you think about the market there.
Well, the word you emphasize is need. I think it's good that there are, personally, because I think anyone that wants to bring capital and mentorship, right, to bear for startups and is well-intentioned, I think that's really great, because entrepreneurs, founders need a place to try and to, some capital to make it happen. And when that's happening, even if they fail, I think it's additive to the startup communities that they're in. I think ultimately what accelerators bring to the table. And Brad, my co-founder, coined that word because there was no word for it back in the day. Ultimately what we're bringing to the table, right, is a little bit of capital, a context to, get feedback and experiment. And over time, what it's evolved into is the best ones, you really bring in the best networks and the best relationships in those networks. So, there are something like 20,000, unique investors that have invested in a Techstars company now. Right. So that's a lot of relationships that we can sort of try to match to the right founders at the right time based on those investors and their interests. but just the network at large, right? The tens of thousands of mentors and alumni that are around the system that want to support each other, want to give first to each other, across the system. It's just a powerful entrepreneurial network. I think ultimately that's really where the value is.
I do want to come back to community because that's really core to what you guys do. But I want to talk about an open letter you wrote in June. You'd been back in the CEO's chair for a year. And among other things, you talked about 3 recommitments from Techstars. And one of them really jumped out to me, which was bigger isn't better, better is better.
Yeah.
I'd love to get you rolling on that, what that means to you.
Yeah, sure. And just for context, the sort of recommitments I came back with, that's one of them. The others embrace startup communities. That's how we got where we are, by really partnering with the startup communities that we operate in around the world, as well as just, extreme focus on helping founders succeed, right? Sort of founder is the customer lens, but bigger isn't better, better is better. I think Techstars got a little lost there as it scaled over the years, where it started to equate bigger with somehow better. And I think those are just different dimensions, right? You can be better and it might lead you to be bigger, but not necessarily. You can be better and be smaller, right? They're just different dimensions. And so we've really tried to pull apart that language internally and do things that make Techstars better every single day for founders. And examples of that are, launching an improved offer, right, across the system for more capital, better terms, right? New and improved online systems. It's not getting better because we're funding 2 or 3 more companies, in a time frame. It's getting better because we're funding better companies, providing them with better resources, surrounding them with better people. So I think the easy example is a bigger computer better? Not necessarily, right? It might be, but I think when people conflate those two things as they scale businesses, it can lead to challenges. And we've really focused on that the last year since I've come back, and really focused on better every day, not bigger every day.
Yeah. I mean, you wouldn't be the only accelerator that's probably focused on the better is better piece coming out of, big reset and venture, which obviously affected everyone and, has nothing to do with accelerators in particular. I did talk to probably 3-ish years ago, one of your MDs who's great and I still know, but at the time we were talking about big goals and he was talking about how many thousands of companies they'd love to back at Techstars. And I'm rusty on the specific number, but I asked, how much could you do in a year? And the number that he floated that he felt like Techstars could ultimately back aspirationally was just so huge. And I pushed back on it. I was like, are there really that many venture backable startups out there? And, that could have just been kind of sign of the times. But I guess to get back to what you're saying, sometimes tighten things up. Sometimes better is better rather than
Yeah,
bigger.
I mean, for anybody that is building something that's scaling well and feeling a lot of pull, right? It can become the natural gravity, right? Is, well, we're doing a couple hundred companies a year. Why can't we do 300 or 500 or 1,000? Right? And that would be fine if all of those 1,000 were making everything better, if the portfolio was getting better, if the investment activity was stronger. And so, it turns out there is, a dimension of quality you need to pay attention to as well. If there were 5,000 companies a year to go fund that were all super high quality and we could help them all, of course, we would love to do that. But I don't think we're anywhere near that from a capabilities perspective. We're maybe funding a few hundred companies a year right across the world. And we think we can do that with really high quality. So as we improve what we're doing and make it better, and we want to add one more, that's fine. There's nothing wrong with bigger, right? It's just that you got to have the right balance with sort of better and the quality of everything. And so we've just really taken the focus off of that. We have so many opportunities to, continue investing in our own portfolio, our mentors, funds that get created. There's now 30 or 40 funds that have been created as a result of Techstars activity from mentors, from founders, from former employees. There's just so much to do that doesn't depend on, sort of more portfolio companies.
You mentioned earlier revamping the offer for founders.
Yeah.
And I know that varies by region, and you correct me if I'm wrong, so I won't get into specifics of what it is. But the US offer in particular, having looked at what it was before, it seems like a much better offer for founders. Curious, what the discussion process was like on figuring out what that should look like and what their response has been from founders?
Yeah. The regionality of it is actually only sort of Asia Pacific. It's different, but everywhere else it's the, sort of 200,000 uncapped plus the 20,000 piece, which is just motivated by, again, better is better. One of the first things that I came back, I said, I feel like we, in order to improve quality, need to improve this offer, right? It's been a little while, and looked at all of the data we have and looked at Monte Carlo simulations of where those investments go over time, and I think we looked at 40 different sort of possible offers, something in that zone, and narrowed it down to two or three. Talked to a bunch of customers, the founders about it, tested it internally a bit around how does it feel to the founders that we're trying to attract, and landed on this notion of, we're going to be a common stockholder in each company and essentially in exchange for the accelerator program. But then we want to offer, a nice chunk of uncapped money that really doesn't have an opinion about your valuation. And so the reaction of the market has been, very, very, very strong. I think we are, anecdotally seeing very strong founders and companies, including those that, are telling us, I just didn't apply before, right? Because of what the deal is. So it's more, it meets the market where it is. It's more compatible with other investors that want to be involved in the company and know that a lot of that money is going to convert at whatever price they want to invest at. So, a little bit of science, a lot of feel, and a little bit of market
Talking to your
testing.
customers.
Yeah, like you do with anything else, right? And it's been, I feel like, the volume of applications is more or less what it was, but the quality feels like it's way up. And as I sit on the investment committee and see it across the world, I can feel that.
I read that you guys have seen roughly a 3x in applications since 2021. That sounds roughly right. That's enormous. Probably flies in the face of what I would have guessed. What do you chalk that up to?
I think what happens is during the sort of downturns, pandemics, capital becomes a bit more scarce. Investors are pulling back, right? They're being pickier and they're being slower, and it's deliberate, and it's probably really healthy. But when your offer is unchanged and you're you're doing what you were doing before, same number of, companies, same pacing, suddenly you get more interest. So we've always known that when our market dips, we see those type of increases just because of capital availability in general. But I think the other dynamic, which gets talked about a lot, is people were just, being laid off and, starting companies, right? That the company creation in general has gone up significantly across the board. And so, naturally you're going to have more demand for everything that's out there to support that. So it's a combination of those two things.
I read a study about the success of accelerators that found the punchline is they were very effective. So there were a couple dimensions that they studied. One was, are the companies that accelerators make offers to ultimately doing better? So are they good at picking, or are they good at adding value once they come in? And what they found is that once companies came through the program, the ones who went through the programs had better performance than those who were picked and opted not to go in. So to me, pretty validating and intuitive. Makes sense. You surround yourself with hungry people and great mentors and whatnot, and you think it'd be helpful. And the authors speculated as to what they thought were contributing to that. But from you, I'd love to hear, what do you think it is that is the extra sauce that makes it that much more helpful?
Yeah. Now that the sort of space of accelerators is, been around for 15, 20 years, there's enough data, right, to really look at total outcomes across time. And there's now been 4 or 5 studies that ones I've seen particularly call out the ones that, we all know about and have heard of. Harder to study on a smaller one. But I think it is ultimately the people, right? I mean, we all were, 15 minutes into a podcast, we haven't said the word AI yet. People think, oh, AI is going to take over and build all the startups, but it's still a deeply human endeavor. The creativity around it, the credibility around it, the network, the capital that we need to attract as founders, those are human relationships, right? And ultimately, when you have a team, right, that is this broad network all over the world, you've got founders that are 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 years ahead of you, having, been in your shoes, the combination of that advice and experience, built-in customers in that network, and just connections, like to be able to get to somebody quickly and talk to them and have it impact your company. I think that, again, the network is really the primary benefit. We teach stuff. People think, oh, accelerators must look like a school, but from being involved, it's really, what does this particular company, this particular founder need? How can we find that in our network and try to, give them some feedback, but really go deep with a few people that can change the game for them. So ultimately, I think it's people, 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 whether those are other alumni, the mentors, the investors that have an affinity to the system, that give founders real advantage. And that's why you see the lift in the number when they study it. The outcomes are just better.
Techstars has an interesting model in that you have the umbrella, but then you have the individual programs where the MDs have, is what I can tell from talking to current former ones, a ton of autonomy. How do you approach that balance of having your vision of what a Techstars company is with giving the MDs autonomy to go out and back the best deals they see, best founders?
Well, another thing that we've done is we've really focused on our own investment committee and how the process works globally. So these managing directors that are in the markets, that we operate in, we're in, 10 or 12 countries and, 30 plus cities, right, doing these programs. And they are there on the ground and sourcing companies that are relevant for them. But ultimately, we want to ensure that quality across the system, right? If you get the best 10 companies in, London, are they as good as the best 10 in New York, right? They might be better, might not be, but we have to see that as an investment committee. So Brad Feld, myself, Andrew Cleland, and a few of our really longer tenured MDs, we look at every single deal across the system. And that enables us to calibrate, what people are bringing in, give feedback, also connections across the system, because often, if you're looking at a company that's doing something in the space domain, you want to have a few experts that are really deep in that join you for that discussion. And so just having that, sort of layer on it, which is, again, a quality layer, the investment committee that's ultimately responsible. There's a lot of autonomy in the field, in the execution of the programs, in the sourcing, but ultimately it's very collaborative in terms of the quality of the companies that we're picking. I think that's been the key to maintain that.
What to you are the hallmarks of like a Techstars company coming in? When you see it, you're like, oh, that's one.
Like, I think on some level they want the coaching, right? Like they're not just like, no, don't talk to me, I'm heads down. They know that they probably have something that they can improve. They are often open about whatever their weaknesses are. We all have them, right? And when you stick them on the table and look at them and say, wow, that's ugly, how can we fix that? That's a lot of what we do as mentors, right? We love that honesty and that transparency. But they're also, really good storytellers, right? The ones that really work, they get people excited about what they're doing. They're good at leveraging the networks, right, that they're put into and that they can take advantage of. And ultimately, they're just obsessed with what they're trying to do, right? The problem they're trying to solve in the world. They're not attached to their solution. They're attached to fixing the problem, right? And are willing to change what they're doing and adapt to the data that's coming back at them from their customers and advisors. Those are some of the common traits, right? But this sort of obsession with what they're trying to fix in the world and this intrinsic motivation for why they're trying to fix it, to me, are the things that I really look for in interviews and, that stand out to me.
You guys paused programs, Berlin, Paris, restarted Chicago, Boulder, Atlanta, started in San Francisco. There are a lot of variables. I'd love to know, what are the key variables for you on being in a market that's a good fit for you guys?
I think it's, some of it is just capital and where capital is available to us. And, some of it is the people, like anything else, right? Who are the managing directors or team members that we have in which markets, and how does that evolve over time? That there's a minimum bar for the startup community, right? We work with startup communities in different ways. Our accelerator is just one way we work with them, but much like Google or someone, lays fiber in places they might want to be someday and builds the infrastructure, we do that with something called startup community partnerships. So we want to be operating in a community as a partner to that community and helping it grow and thrive as a community, connect it to our network before we're ever investing there, right? And so the accelerator is sort of like the last step. And so, as we need to shape the system, it's the people, it's the, best places, and it's the availability of capital that kind of shape it over time. And, you hate to come and go from markets, but again, one of the things we've been doing to try to get quality is not be so focused on quantity, right? To maybe have more money and better companies, right? A few fewer markets. And so we've really been trying to focus on the places that we feel have the most interesting founders, but leverage the rest of the network to source companies from all over the world.
San Francisco being pretty notable addition to the roster. I'd love to hear more about the thinking there.
It's an interesting one. The
And I
arc
should
of
say
the
on the thinking, like superficially, I get it. Like it's obviously a giant
yeah,
market, but it's more, I guess, the interesting piece is you guys weren't there for a very long time
right.
and made the decision to enter, and that's the piece.
And for people listening that don't know the whole arc of the 18 years, right? I was running or co-running the company, CEO or co-CEO for the first 14 years. There was a new team that came in. I was very supportive of that. I stepped back as chairman and came back a year ago when the transition happened there. And I think in that period where I wasn't running the company is when we did decide to go to the Bay Area. And it's been awesome. Look, the Bay Area has so many resources for so many founders, right? It's obviously hard to be really differentiated there for anybody. But it is a place, of course, where there's a lot of investors, a lot of capital. A lot of our existing portfolio companies end up there, right? I mean, people always like to tell stories about everything is in San Francisco, but the people that tell those stories often didn't start there, right? They often started somewhere else. And that's what we're seeing is companies that started in Boulder or New York or Seattle or wherever, often as they scale, they do end up with a pretty big presence there. So being there is important for that reason. But it is relatively new for us to be part of that market. And it's been an interesting journey trying to get all the right connections and have people understand who we are and what we do, because a lot of the investors there, they just want to see later stage deals, for example. And so another accelerator doesn't get them excited, but we have enough later stage deals to show them that we can do both.
How is the program from like a class or experience perspective for founders? How has that evolved over the last, let's call it 5 years?
It's pretty bespoke. It always has been pretty tailored to the individual companies in the program. The feedback we've got sometimes is the founder stories are great, but we could do them anytime, right? So let's do more focus on our own growth, our own KPIs, whatever we need in the moment. So I think it's getting a little bit more, just in time, right? So financial modeling being an example, right? Rather than teaching a class on financial modeling during every accelerator program, there's probably 5 companies that really need that right now and 5 that don't. And so virtualizing that, making it available more on demand, making the mentors, like a Troy Hennekoff that would teach a thing like that, available more on demand for people. Right thing at the right time. Again, part of the better for founders, just listening to that feedback and quality improvement. But fundamentally, it is, we've stayed focused on small class sizes, right? It's 8 to 12 companies at a time, very focused team working with those companies, broader leverage from the network. So you don't feel like you're lost in the shuffle of, 100 companies all doing the same thing at the same time, with sort of a celebratory, community-oriented demo day at the end, but a lot more emphasis on, getting the right investment opportunities in front of the right investors globally. So a lot of virtual connections happening outside, demo day, which is really just more of a local celebration of what's happening in that community.
What's the biggest course correction you see with founders when they come in, where from beginning to end of program, the biggest change in what they're doing or how they're thinking about growing their business?
It's hard to pick the biggest one. It's all over the map, right? I mean, you have complete pivots, right? Where you wouldn't recognize what they're doing anymore because they learned that it wasn't going to work or got conviction about a different or better thing. Could be a totally different market. It also depends on the ones that are going to work or the ones that aren't going to work, right? But ultimately, I find that a lot of the best companies, they come in with a bit of hubris because they are really interesting, right? They're a little bit cocky, right? They want to create the FOMO and they think, we're just here to, raise the capital, but then they start to get the feedback and they start to realize that the network is adding value, whether that's feedback on what they're doing or customer wins so that they can learn from those customers, right? Investors giving them candid feedback rather than just saying, no, it's not you, it's me. They tell them what they're actually struggling with and thinking about their company, which allows them to improve. It's the loss of that hubris. It's the dropping of that defense shield that I find so powerful. And I'm sure you've experienced that moment mentoring, if not at Techstars somewhere, where it's like, oh, now you're showing me warts and all what's really going on, and now I can help you. And that's how we build our relationship. And that's how I see what you really can do about the real problems that you have, rather than just trying to show me that everything's perfect, which isn't helpful. So that's the metamorphosis that I think is always really powerful. You see a lot in accelerators because trust builds, with the people that they're working with over a little bit longer period of time than most investors will engage, at least initially. And so I love, when that happens, it's always very powerful.
Yeah, I've mentored a startup going from kind of front to back, the full program or class length, but I've also done several mentor madness. I don't know the plural of madnesses.
Sure.
Those are so fun. I don't know if you do them in all programs. I did a bunch with Detroit.
Yeah.
And they were so fun for me because for anyone who's not familiar, basically they have the founders line up and kind of speed date with a bunch of different mentors in different capacities, and they get quick feedback. And I've done mentor madness on the early side where I know that I've been earlier in the programming of them doing it. And I've done it where it's on the later side where they've already done dozens of conversations. And it is remarkable to see how much tighter the conversations are with the founders who've been through a whole lot of them. And it's not just that they're better at pitching, it's that they've helped. I think all those conversations help to refine the idea and the premise of what they're doing and challenge some of their thinking and sharpen it in a lot of places. And for me, that was always a really interesting experience working with you folks.
Yeah, and it is a crazy couple of days for everyone when we do that. And we do generally do that across the system. We often refer to, these accelerators as kind of the, the quarterly miracle, right? It's this 3-month program, and you sort of looking at the companies on day one, as much hubris as they have coming in, and then seeing what they're saying and what they're doing on day 90 is really night and day. And it's just, that if that's the only 2 snapshots you get of it, you really notice it. And, ultimately that mentor, sort of magic or madness, it gets called different things, is about creating quick connections. Like somebody who gets it and it's like, oh, that's really interesting. That signal for that founder is that person's probably more likely to want to engage with you longer term, right? It's a way of identifying who might really click with you. And often people have very snap judgments that, just like blank type reactions, right? That are really, really useful, especially when you hear it like 4 out of 12 meetings. It's like, wow, that's a common concern or reaction. I should probably pay attention because these are a bunch of smart people. Doesn't mean you have to do something different, but you're getting really quick and sort of high frequency feedback without a huge time investment, and you're building initial relationships. So it's a part of the secret sauce early in the program, I think.
Is later stage or growth stage of any interest to you? I know that might feel a little non-core considering you guys just kind of reset your priorities, but I'm curious how you think about, you've backed over 4,000 companies over the years, maybe 5,000 now. Obviously, I think I read 21 of those have gone on to be unicorns. Do you try to grow those relationships, put more capital behind some of those that turn out to be significant wins, or are you more or less happy with what you work out from the initial deals?
No, we have 2 strategies. So as an asset manager, it's somewhere around 1.2 billion of capital under management today. Obviously, regulatory AUM is much bigger; it grows, but that's the capital we're managing. And we have strategy 1, which is the accelerator, which you're talking about, where we sort of write that first check. We're often the first real investor, at least alongside the first real investors. They go through the accelerator program. We have a separate strategy, and we do have separate funds that do this for follow-on. Now, those are pro rata, sort of funds. They're not, trying to own more than we already own. They're not trying to win the deal from the market. They're trying to maintain their ownership. But those numbers get bigger over time. So we do that as a strategy as well. I think that's a growth opportunity for us. That capital turns out scales faster than the capital we're deploying at the accelerator stage, because I think every year, last I looked, our portfolio companies were raising $2 or $3 billion, every year from the market. And so for us to be holding our ownership, low single digits, mid single digit ownership, it's significant capital that we can be deploying. So it is part of our strategy, and I think we can do it even longer in the life cycle of the best companies. We've done that in a few cases, but ultimately, we would need more capital to be able to do that.
We made it pretty far into the conversation without talking about AI, but I am going to ask about it. Not so much an AGI question, but I'm curious kind of where rubber meets the road with vibe coding in your program. So, flashback even just a couple of years, I think a lot of particularly non-technical founders, a lot of the early work is just around building out an MVP and the complexity and challenges of that. The hurdle for building an MVP these days has gotten very, very low.
Right.
I'm curious what that means for founders coming through your program and what it means for you evaluating ones who want to come in.
Yeah, you're totally right. I mean, it's almost on the floor, right? You just kind of skip over it. And if all you need is a quick UX, store data, retrieve data, show me some marketing, that's done, right? And so investors know that, and founders know that. And so I think it puts a little bit of a premium on that storytelling, that vision, and also actually having a good long-term concept, right? That is going to work and last. There's a lot of things in the AI space that, which to me, by the way, that's just like the new word for software. That's how I think about AI. I just replace, anytime somebody says AI, I just translate it like almost as if it's Spanish to English. Oh, okay, software. Software is just getting really smart, right? Really intelligent. It's always been doing that, but it's doing it now at a very rapid rate. There are a lot of things that people are creating now that are going to have value for a year or two, but they're not going to have value in 4 or 5 or 10 years, right? Because it's going to be the generic models are going to be able to answer those questions or solve those problems. And so it's about sort of lasting advantage, lasting vision versus initial, prototyping, which is now so easy. Anyone can do it. I can even do it, right? So there you go. And, I think storytelling, as I said, bringing that out, the ability to get people excited about what you're doing, to attract the other humans that you need around this to get creative, to give you credibility, to go and get those deals done in their own networks. That's the new skill, right? I used to say it's design, but even that now is such a lower bar, right? I thought it was moving from engineers to designers. Now I think it's moving to storytellers.
What's a conventional view in venture or investing in startups that you think is BS?
I have to pick one.
You can pick more than one if you want.
I mean, the whole industry is BS, right? You know that. On average, we're not adding any value, or as financial managers, but some of us are, and some of us aren't. But it's it's like anything else in the financial industry. It's fees and identifying where to flow money and sort of being that middleman, right? But I think the big there's two that come to mind. One is just this geographical thing that we talked a little bit about, right? Like, oh, all the best startups are in the Bay Area, or they're all in these geographies. And it's just so not true. Right? It's just like categorically, obviously not true anymore. And so, these places are trying to hold on to that mythology, and they certainly have a population advantage, right? Sort of sexiness advantage. But we see the best companies in our network, and, they're coming from everywhere. Right. And they're moving to these places. And so you can do this anywhere. That's the good news as a founder, right? Anywhere where there's a bit of a thriving startup community, you can be part of global networks. The world is more virtual. We're doing this virtually, right? Across a few states. Anybody can do that. People are used to doing that. So I think that whole you got to be somewhere mythology is kind of on its way out, still being, clung onto by some. So that's one. The other is, hey, as an investor, you got to have a small concentrated portfolio, and you got to sit on the board. That's the only strategy that works in venture. And I can see that that's not true. That it's not that it doesn't work. It's that there are other strategies that can work. And, as this asset class of venture matures and we have more data, we have more science around it, there are many pretty clear studies as well that, again, you got to pay attention to things like the price you pay, but concentrated portfolios are not necessarily as safe, right? Venture capital is viewed as this very unsafe asset class, but diversification in any asset class is the key to making it more safe, right? And so I think the world is learning that. And so as we move into a future where everyone can address private equity and venture capital as a type of asset, not just the wealthy, that's going to be an important part of the asset mix is creating consistency rather than this venture fund performance that people are used to seeing as 100 IRR this month and negative 10 in the next fund, right? And it'll all average out. There are multiple approaches that work in this asset class, just like there are managed funds and unmanaged funds. So I think the sort of two mythologies I'd sort of pin down would be geography matters more than anything. Where you are matters more than anything. You can't do it there. And, sort of fighting the diversification that is natural in any asset class in order to sort of have these small concentrated portfolios that are very volatile.
David, this has been really fun. Oftentimes I'll ask folks, what's the best way for listeners to get in touch? But Techstars does a great job of making that pretty straightforward, and they don't need to ring you. But maybe something you could answer just to wrap things up, because there are a lot of founders who listen to the show as well as investors, is if they're thinking about applying to Techstars, you guys have a lot of different programs. How should they think about which ones might be the best fits for them?
Yeah, I mean, if you're already in a place and you want to live there and you want to be there and we operate there, that's the easy decision, right? It's I think again this idea that you have to move away from somewhere that you want to be. We that's why we want to be in all these markets. If you're not, and you think, hey, maybe being connected to that market, I'm a fintech company, right? Maybe being connected in London or in New York, where there's a lot of that activity, would be valuable. There's some affinity you have to the place or to the network around that place that is fairly obvious. I think that's how I would think about it. There's also virtual programs. We have our anywhere programs, right? That you don't have to pick up and move from where you are for a few months. So, we're trying to make sure that it's accessible to everyone.
Great. Well, David, thanks again for coming on the show. This was fun.
Of course, Joe. Yeah, great to see you.
Thanks for listening to the show. We really appreciate the support and would love it if you'd subscribe to the podcast on iTunes, Spotify, your preferred podcast platform. One more thing. Investing in startups does not have sponsors, but I want to give a shout out to one of our portfolio companies, Micro One. Micro One helps businesses ranging from startups to enterprises to source world-class software engineers. Micro One uses their own AI tools to identify top 1% engineers and get them working for customers in as little as 48 hours. And if Micro One could help one of the largest AI companies in Silicon Valley hire 250 engineers in 30 days, they can probably help you too. If you'd like to learn more, visit microone.ai, and thanks for listening.